Hi, everyone, and thanks for joining us for our webinar today. Before we get started, just as people start coming in, my name's Eliza Berry. I'm Marketing Director at Richey May, and I just wanted to go through a couple of the housekeeping items before we get started. So first, this webinar is being recorded. We will email out the recording in a couple of days to everyone that registered for the webinar. So whether you're watching live right now or need to tune into it later, we'll have that available. It will also be, the link will just go to our YouTube channel. So feel free to share it with anyone at your company where it might be applicable, or to refer to it later whenever you need to review it. We definitely expect some questions. So if you have a question, you can go ahead and ask that either in the questions panel or in the chat. If it's something that's just a general housekeeping item like contact information or whatever, I will answer that. Otherwise, I'll pipe up and ask it to the speakers while they're presenting, or we will get to it at the end. With that out of the way, I will go ahead and introduce Kaylin, who is going to get us started today talking about how to prepare for your audit.
Thanks, Eliza. Yes, everyone, thank you very much for joining us today. Echo Eliza's thanks and appreciation. We've got a good group, so we're excited. As Eliza stated, we're planning on covering how to prepare for your Richey May audit and going to cover some other year-end updates today. Just quick note for the recorded video, we are coming to you live right now. It is November 11th, 2020, and we'll be distributing this video, as Eliza said, hereafter. For those of you who I may not know, my name is Kaylin Richey. I am Richey May's Director of Client Experience, and in this role, I lead the firm's efforts to learn and understand our clients better, so that we can respond and anticipate their needs, your needs. It's a real privilege to be joined today by Mr. Josh Jensen. Josh is a seasoned leader, having spent 9 years here at the firm. He's currently a senior manager in the mortgage banking audit practice. Josh is definitely the ideal team member when it comes to, in my mind, definitely the ideal team member to be presenting to you all today on this topic. Mainly because Josh certainly stays immersed in the state of the industry. He serves on our local state association board here, the Colorado Mortgage Lenders Association, and is always staying up to date with anything coming out of the influencers of the industry, and then also staying in tune with what his clients are either worried about or excited about. So definitely a privilege to be joined by Josh today. Josh, another reason he's the ideal person to be bringing this to you is it was his idea, so makes my life a lot easier when one of my team members comes to me with an idea to deliver some value to our clients. So our purpose today is certainly it was born out of a simple question, really. We said, how can we make our clients' lives easier, especially with the wild, unusual bumpy road that 2020 has dealt us. We hope you gain some useful insights and value in this presentation, and at a very minimum, maybe help you feel more comfortable collaborating and communicating with your audit team members, knowing that we're all in this together and we all have the shared interest of making this audit season go as smoothly as possible. Josh, did I miss anything there? Do you have any opening remarks?
No, Kaylin, I think you covered it. Just wanted to again, kind of note the date. November 11th, Veterans Day. Obviously, wanted to, share our acknowledgement of and appreciation for our veterans, both serving, currently or in the past. And also, yeah, Kaylin, thanks for the intro. Eliza, similar. I think really, to Kaylin's point, most of us very much so are zoomed out or GoToMeeting out or whatever it might be, but we felt that this webinar was pretty timely, just kind of given what's been going on, not only in the industry, it's been just a phenomenal year, I think, that mortgage lenders have been able to, kind of sharing that experience with first-time home buyers, or even, giving them the opportunity to refinance their loans and save a couple $100s a month, whatever it might be. So as we're, moving into Q4, kind of the unknown of 2021, definitely wanted to kind of get ahead of this. And for those, current clients, kind of touch base. Obviously, we're, kind of midstream from a standpoint of working through interim work and compliance work. And then for any prospective clients, kind of give you a feel for, and Kaylin touched on it, what it looks like to go through Richey May audit. I think for those that are on this call that have experienced Richey May audit, they might speak to, that first year, being a little unique, could be a little challenging. And what we wanted to kind of discuss through this webinar is, expectations, especially, kind of given the current climate. So that's my opening remarks. As we kind of move through this, obviously, as much as possible, we'll spend some time doing a little Q&A, but really wanted to cover a broad, kind of range of topics as we prepare for year end. So here, again, topical outline. I won't spend too much time here, but really kind of the bookends of this presentation. It's going to be a lot more of the timely, kind of the timely nature of what's been going on, not only in the industry, but just, nationally. So talking about, accounting issues and updates, PPP forgiveness, lease accounting, loan loss reserves, kind of the meat of how to prepare for an audit, learning from the past, what slowed us down, talking about remote audit logistics. Obviously this year, presents some unique challenges, especially for clients that are used to us being, kind of boots on the ground in their office, working through the audit, planning ahead, setting expectations, both internally and externally, maintaining those open lines of communication, and then finally just looking at, other impacts to 2020, just in light of more recent events, what the climate looks like as we enter 2021, forbearances, delinquencies, the market refi fee that's coming up here, December 1, and a few other things. Anything to add there, Kaylin?
No, one thing I failed to mention though, real quick, I'm going to do my best to, play the role of you, our clients, as I kind of interject some questions here. But certainly, as Eliza mentioned, please submit any questions that might come up for you in the chat box, and we'll do our best to address them today. If not live here, certainly follow up with you after. So if I'm not doing a good job of playing client, please take over by using that chat feature, and I'll try to insert your questions and get them to Josh.
All right, so we can, kind of dive right in with what our current accounting issues are, updates for 2020. I think the biggest item from an audit standpoint, definitely this year. And I guess, I want to, say up front, I guess if you didn't submit for a PPP loan, you can probably go top off your coffee or go up that, cup of soup, so you can kind of zone out for a couple of minutes. But if you did apply for a PPP loan and you have that on the books right now, how does that affect the audit? Again, pretty recently, that forgiveness portal opened up in October 2nd, requiring lenders or borrowers, I guess, to submit those forms 3509. But we do want to, mention that we're still kind of in that, in that comment period where there could be some changes to it. Things aren't finalized until November 25th. We have heard some people, going through the process, they're starting the process. But really, our recommendation, I guess, is really just to work with that lender as far as when they're going to be open. We've heard, some of the banks haven't even opened up their portal just because they're kind of in that wait and see approach, see if there's any additional legislation that comes out in regards to this. Kind of flash forward into what the audit impact is. So again, from an audit standpoint, what we're going to be looking at Richey May is the loan documents, right? So we're going to be looking at the application. We're going to be looking at the proof of cash receipt, and then just an update on forgiveness status. So one item I've already been covering a lot with my clients in the fall is just gaining an understanding of the amount, where they are in that forgiveness status, when they plan to apply for forgiveness, making sure that that loan is on the books. And then, as we flash forward and look at year end, if that loan hasn't been forgiven, or if it's still in process, potential for sending a confirm, so similar to like a warehouse debt confirm or a note payable confirm. So we would be confirming that debt amount with the lender. Again, as we talk about the presentation on the financial statements, so how is this going to affect my financials? It's our opinion, there's two trains of thought here. Whether it should be accounted for as a debt instrument under ASC 470, or potentially looking at the IAS 20 grant model. Richey May, we've done a lot of, kind of digging into, what this loan means, how it should be accounted for, and we keep going back to ASC 470 and looking at this from a standpoint of it should be a debt instrument. It should be accounted for as a note payable on the balance sheet. Issuance costs, as we look at, the doc preparation, any accounting, any legal advice that went into the application process could be, depending upon the materiality of it, amortized over the period of the loan. So that could also be potentially on the balance sheet. And then additionally, that interest expense. So you should be accruing for that, the stated interest rate of 1% on a monthly basis. If we flash forward, and go into 2021, or if that forgiveness period actually happens in 2020, it could potentially look at, that loan being forgiven, essentially coming off the balance sheet and then moving into the statement of operations as, essentially a forgivable loan, which would be great, right? Cash flow presentation is another item. Again, for 2020, what we expect to see, a single line item, cash proceeds from the loan will be classified as a cash from financing activity. And then if we flash forward to any, forgiveness amounts, that would be classified as a non-cash financing activity.
So Josh, what I hear you saying is this loan, if I have a PPP loan, it's likely going to be on my year-end financials on my balance sheet as debt. Is that right?
That's right, yeah. And then
somehow magically get my approval of forgiveness pushed through here in December.
If it magically happens, yeah, for sure. I think, the lenders, obviously the SBA has, 90 days to make that determination once the forgiveness has been submitted by the lenders. So, I think with that window opening up October 2nd, 90 days from that period actually is 12/31. So, there's a strong likelihood that none of these loans, or very few of them, obviously, have even gone through that process. So, more of a wait and see. I feel like that forgiveness event will be a 2021 event. Before we get on to the tax impact, definitely wanted to discuss, what it means from the footnote standpoint. So again, we'll touch on it here in a little bit. But we do have a footnote disclosure written up that just discusses the terms of the loan, kind of where the loan came from. We'll talk about the terms, where it stands, and then if there is, between 12/31 and when we're actually performing the audit, or if we finalize the audit, and there has been an event, a forgiveness event, we would definitely want to note that as a subsequent event as well. So that could be, it's definitely going to be a footnote disclosure for the note payable piece, but there could also be a subsequent event footnote in regards to that forgiveness piece. From a tax standpoint, as it currently stands, the AICPA I know has been frustrated, and I think many of our clients have been frustrated, I think, from a standpoint of the expenses that are being utilized, whether it's payroll, whether it's rent, utilities, are currently ineligible for tax deductions. I know the Treasury is kind of still fighting on that, but they plan to issue more direct guidance in the near future. Kaylin, any update on that end, or is that?
Yeah, I'll step right out of those client shoes that I put myself in already. Just to note that yes, it's very confusing because the potential to have all of the events transpire in the same calendar year, and usually that correlates with the tax year, to have a real debt and real expenses that would otherwise in any other situation be tax deductible, it is now straddling into the next calendar year potentially, right? So think about the likelihood that you're not forgiven of your PPP loan until 2021. Well, until you know that you're going to be forgiven, these expenses seemingly should be deductible. There's no mechanism to prevent you really from deducting these expenses, because up until December 31st, the end of the period that your tax return is being filed for, you have a real debt, and you use the debt to pay for deductible expenses. So we expect, again, as Josh said, for more, the IRS or the Treasury or both have to come out and give guidance on that. It'd be, I guess there's nothing preventing another unprecedented event from happening in these times, but it's unprecedented to not have guidance on something like this, where an income event would happen just in one tax year, just to reverse kind of a expense or deduction event in a prior year. So expect more to come, hopefully here before the end of the year. Certainly, I think we expect it at the latest before the tax filing season opens, when they approve forms sometime in early February, probably. So thanks, Josh, for letting me interrupt there. I'll step back into my client's shoes. What I think another item that was set to take effect, right? I've been preparing for lease accounting to make an impact to my financials. What's the latest with lease accounting?
Yeah, great question. So, with lease accounting, again, in May of 2020, FASB did vote to delay that an additional year. So again, the effective date for private entities, they must apply ASC 842 by reporting periods beginning after December 15th, 2021. So what that really means is, that January 1, again, for our 1231 clients, that January 1, 2022 date is really going to be when you need to start representing the effect of this standard on your balance sheet. Yeah, so again, we've had a handful of early adopters. Kind of there's two mindsets, I think, with ASC 842. They either outsource it, either buy a software. There's a handful out there that do a lot of the work for you, where you just provide them the lease agreements and they go through, and obviously you pay for the service, and they give you the journal entries you need, the disclosures you need, and all that. And then there's a handful of our clients as well that have done it in-house. So those have, at least up to this point, have been the two plans of attack. But up until recently, so Lease Guru is a software company based out of Atlanta that we've partnershiped with to be able to offer this similar service, but rather than you or the client actually purchasing the software, which can be quite a bit more expensive, and there's a little bit more of that administrative burden for the client. We've been able to kind of cut through that, act as a partner in that, and assist our clients, and kind of utilizing that and tracking that. So I know this thing, it keeps getting pushed off. It keeps getting pushed off, right? There's been some discussion that it may get pushed off an additional year. But we're essentially telling our clients, hey, let's plan like it's going to be a 2022 event. And with that, what plans are you making right now? I mean, I would assume a lot of clients probably budgeted for it as a 2020 event, just to get ramped up for 2021. But I think, as we roll out a busy season, especially this April, May, June, I think that's going to be an ideal time really to, for our clients to, kind of evaluate what they're going to do. Whether it's going to be done in-house, whether it's going to be, outsourced, partnership, whatever it might be.
Yeah, Josh, along those lines, how many leases would I need to have to really start making the business case for seeking out kind of third-party help?
Right, that's a great question. So I think, I'm going to give you three responses to that. I think in terms of the number of leases, I think a good baseline for where it can become a little burdensome is anywhere between that 10 to 15 leases. And when I say leases, that's operating, that's capital, that's any embedded leases through MSAs. Really, there's a lot that can go into this, right? So with that, the second piece of that answer is really kind of the Excel savviness of our clients. Do you have somebody that can be dedicated to building out the necessary calculations and necessary spreadsheets to make sure that you're accounting for this properly? Some clients definitely can do that. Others might be, a little strapped down. And given 2020 and how busy of a year it's been, will you have that kind of time to build this out? I think is a question that definitely everyone needs to ask themselves. And I think a third piece, definitely, if you do build out that program or those Excel spreadsheets to account for all these leases, you've hit that day one transition period, so where you can kind of flip the switch, turn it on, start accounting for these leases on the balance sheet. But really, it's that day two transition or that day two accounting that can be, again, a lot more burdensome. And what we mean by that is it's more the lease maintenance, any amended leases, any renewals, any modifications. So really, there's a lot of legwork that goes into just building it out for that day one. But then obviously the maintenance piece of it as well. So yeah, to answer your question, I feel like anything over 10 to 15. I will plug Lease Query here. I know, and I believe some of the other softwares probably provide something similar, but it's almost essentially kind of their, light version, if you will, where they call it Lease Guru. So, if you have under 9 lease agreements in total, so if you're a smaller shop, don't have a lot of lease agreements, that is a free service that they provide that you can do the calculations on there. But once you hit that 10 threshold, it is a software that you would have to either purchase through them or handle it internally or potentially partnership with an outside resource.
Yeah, it's no secret that, I'll point out here that the commercial real estate industry and those owning kind of buildings that these leases would be on are certainly undergoing some struggles themselves. So I'm sure some creativity or some ways to drudge business back up and get back up and running may offer some additional complexities in the lease area. See on that. How about everybody's favorite, topic that brings us all together in loan loss reserves, Josh?
Right. Yeah. I mean, again, such a unique year, right? Increases in forbearances. Obviously, we're starting to see that taper off a little bit now, which is definitely a good thing. But I think that a lot of clients have, taken a look at this methodology this year, especially, kind of considering the unknown, an increase in refis. What does that mean to my, kind of outstanding loans or book of business? So again, another item of note as we, kind of roll into year end is, if they haven't already made any changes to the methodology, they're definitely considering it. At Richey May, we obviously view this as a management estimate. So, from an audit perspective, it's conversations that we should be having right now. I definitely want to, put that out there. If you're not being asked these questions, I guess, during an interim, and if you have made changes, definitely, let your Richey May auditor know. Hey, we've made a change to this loan loss reserve, and here's the why behind it. And again, from an audit perspective, we want to make sure we can substantiate the why, because essentially, what we want to kind of shade away from or don't run into is that now, we've increased the loan loss reserve by a significant amount. That's great. I think that's definitely warranted, but we don't want to, again, we have a good number of clients that we're able to kind of bump up from an apples to apples comparison, kind of dependent upon their channel of business. So what we want to definitely kind of shy away from or steer clear of, I guess, is making sure that loan loss doesn't get too high. I know in years past, we don't want to get it too low. We want to make sure that that you're properly reserved for if you have any large repurchase demands or indemnifications, that you're covered for those. But I think that there is definitely some strong consideration for increasing that loan loss reserve. So I think what I would tell clients is, again, just making sure, you're letting the auditor know, Kaylin, let me know, how this impacts you, what changes you're looking to make, and make sure we can sign off on it and kind of come to an agreement now, rather than in February or March where we maybe feel like it's too low or too high, and a potential adjustment might occur.
We've got a couple of questions here I wanted to jump in and ask before we get too far away from these topics. So
sure.
I actually have a couple of questions from Katie, but since we were on loan loss reserve, she asked, what is the rule of thumb for the amount? I think she means loan loss reserve for that rule of thumb.
Yeah, again, it's gonna definitely vary by channel, right? But I feel like, as we use our Richey May Select benchmarking tool, if we looked at 2019, I feel like that rule of thumb was somewhere between 5 to 7 basis points on a trailing 12 month of production. I saw it probably as low as maybe 3 to 4. But again, if they're able to substantiate, hey, we haven't had a lot of losses, we kind of run a clean ship here, and then we just haven't had a lot of issues here. 3 basis points I feel like was kind of that low end of the spectrum. And then, looking on the high end, I'd say 12/31/19, 10 basis points was probably, on the high end of things. So again, it was being able to substantiate and be able to prove out, hey, we have had write-offs, or there's been an increase in write-offs, or we have these pending indemnifications that we expect to have. As we flash forward to 12/31/2020, I kind of expect that rule of thumb to increase a little bit. Obviously, it's going to be, a case-by-case basis. If the, mortgage company is able to prove out, we're starting to see an impact. We've seen an impact already on the loan write-off side, and this is why, again, it's going to be handled on a one-on-one basis, and we don't quite have, I think we don't have the 9/30 information for Richey May Select. That should be coming out later this week, if not early next week. But I have seen a little bit of an uptick in just what we've seen across the board for our clients, of maybe 2 or 3 basis points of an increase. So yeah, a long-winded answer to your question is, probably 5 to 7 last year, and it's definitely trending upward this year.
Great. And then the other question she asked was, what was the free software you mentioned that was under 9 leases? I'm assuming that was for Lease Accounting.
That is for Lease Accounting. So we can send out a link to that, but it is Lease Guru, Guru spelled GURU.com. So it is through Lease Query. It's just their free software, or free tracking software, where you can essentially, enter your lease agreements, and then kind of go through that process. So that's definitely something to vet out if you're looking to potentially not worry about doing this in-house.
Great. And then we have 2 questions that are kind of the same thing. One of them was sort of before you finished talking about PPP accounting, was just asking if you could touch base with PPP loan accounting. But I have a more specific question from Mike that says, what risks do you see for lenders, in parentheses, borrowers, because in this case, the lenders are the borrowers, applying for forgiveness if they've earned record profits since receiving the PPP? So I guess they expected kind of the worst, and then it encountered a much more favorable market situation unexpectedly.
Right. Caitlin, you want to touch on this? I know you sat on a few webinars.
Yeah, sure. I'll take this, and certainly have been lucky enough to be privy to some conversations with clients about this very thing. So what's come up recently was what Josh mentioned right at the start, a form that the SBA is passing around right now through the lenders, through the banks that issued the loans, detailing what the SBA is going to do, what they're going to ask for if your PPP loan was over the $2 million threshold. And it certainly seems that what the SBA is asking for starts to develop a kind of a narrative that they want to understand how you performed from after the time you got your loan, and as if that kind of makes that impacts their decision or their stamp of approval for forgiveness. I think my opinion is that if they do take that stance, it's going to be played out in court, because if you go back to the time when most of the mortgage community applied for those loans and got them, it was certainly uncertain in the truest form. You had margin calls going off like crazy. You had no idea where rates were going to go. You had no idea margins were going to thicken up like they did, and that the borrower base would be so robust, considering everyone kind of was planning on this pandemic creating somewhat of a large recession. So I think that the proof is in the moment in time. The certifications were made in the moment that economic uncertainty was apparent and real, and I don't see how that's how the SBA can refute that or argue with that determination in time and make a decision to not forgive based on, you know, subsequent months of a good market. I don't know if that answered the question or not.
Thanks. That's all I have for now.
I guess that in short, I don't know what the SBA's intent is, but this form that they're tossing around does look like they're interested in the financial performance of PPP borrowers after the funding date, which is something I didn't think they'd have the right to ask about.
Thank you for that, Kalen. So I think as we, move on to the next topic, again, kind of talking about the audit and what to expect. These are going to be common issues, right, that we see in testing. These are, kind of the whammies, I guess, if you will, for those that have played Let's Make a Deal or Press Your Luck. I'm sorry, but typical issues that we foresee and kind of come up on, especially with new clients. So when we look at loans held for sale testing, one of the biggest items, and this could be a big year for that, just depending on where the industry is come year end, is timing variances at year end with any loans that are sold or purchased, right there at year end, being able to kind of reconcile your loans held for sale and your warehouse lines of credit. Another item, again, big note this year, I think with MSRs, as companies, if they are retaining MSRs, they're retaining a lot more than they were previously. So making sure that you do have that MSR value assigned to your loan held for sale if you do have a plan on retaining the servicing rights. Additionally, this could be another item of note this year, but any valuation adjustments that you foresee with age or trouble loans. So if you're getting scratch and dent bids, if there's some sort of methodology behind how you're valuing these, but really looking at kind of running over with a fine-tooth comb, 30 days, 60 days, whatever it might be. If they've been sitting on that balance sheet for a while, they probably don't still hold that same fair value estimate. So, again, those seem to be some problem areas we feel from year to year with loans held for sale. As we shoot down to the derivative instrument piece, biggest things, again, especially if you're relying on a third party, whether it's a Compass, MCT, whomever it might be, it's always good practice, I feel, to be doing a couple different things, as the controller, accounting manager, CFO, wherever your position lies, is looking at that listing, making sure there's no duplicate loans. And what I mean by duplicate loans is, from a timing standpoint, has that loan funded and then moved on to the balance sheet? And if so, it shouldn't be accounted for anymore as a derivative asset. So making sure you are, whether it's a VLOOKUP, XLOOKUP, looking at your loans held for sale listing at year end, bumping it up against your hedging report, making sure there's no duplicates. Age and expired interest rate lock commitments as well. This always seems to be, kind of a problem area. Loans that maybe just stay on the listing for a little bit too long, or they're aged. Again, just looking at anything that might have expired and trying to identify whether or not that still is a locked commitment at year end. Before I get to pull through, just touch really briefly on best effort commitments. That's another item, depending on if you do have any best efforts. A lot of time the hedging companies don't track those and you have to track them separately. And one item we do see occasionally is that clients aren't keeping that asset on the balance sheet. So just making sure that it is recognized on the balance sheet. On the pull through item, again, that's probably a big item of note this year. There's been some pretty significant swings in pull through percentages, especially, given the current environment, current climate. I feel like we saw a pretty significant dip there towards the end of Q1, early Q2, and it seems like pull through for the most part has come down a little bit. Here's an item, probably a best practice that we're letting our clients know. We do a pretty thorough job of analyzing this and really kind of bumping it up against actual, especially if the audit's being done, later in February or even in March, that we can really kind of look at whether or not the locks pulled through and came onto the balance sheet. So it's just something to be mindful of is it probably performing a pull-through analysis as an independent practice from your secondary or from that hedging provider, and taking a look, at your Q4 pull-through and not necessarily relying maybe on a weighted average over the last couple of years or whatever it might be, but making sure that that Q4 pull through is pretty set. So I think that that's definitely an item of note for this year. Mortgage servicing rights, again, probably most of you that do retain servicing have been putting everything you can into that portfolio this year. Common issues that we see is the additions that as they're going on to the balance sheet, they're not being recorded at fair value. Maybe they're coming in a little low or even a little high, so just making sure that that's dialed in. We've also seen warehouse loans being included in the MSR asset. Typically, again, they're on there, because they're on your balance sheet, but just making sure that because they still are, the loan amount is on your balance sheet, that it's not included as part of that MSR asset, even if you are servicing that loan. On the fair value side, so if you are accounting for the loans at fair value, just something to be mindful of if you are going out for a third-party valuation on that. A lot of those valuation companies give you a range. They give you, hey, it's 80 basis points, but it could be 72 and it could be 88. Making sure that you're sticking to what you always have been sticking to, or if you've made an adjustment to it, sticking to that adjustment. So what we don't want to see is clients moving up and down, kind of what makes most sense during the period of time, or even going outside of that range. On the low com side, looking at the period that you're amortizing the loans, we've seen some inappropriate amortization periods. And then potentially like a lack of impairment testing. So again, that impairment testing should be, performed pretty regularly, but at least for every reporting period. So those seem to be, some of those common issues in some of the higher risk areas of the audit.
Josh, I know that my third-party valuation on MSRs is considers a lot of things in the modeling. Only one of which is, the current market, what exists out there for trades of those MSRs.
Right.
Let's just say the lender, it's my perspective that there isn't a market, or those values are next to nothing. Is there any substantiation I have to take what that current market is and somewhat disagree maybe with my valuation and keep those values, the MSRs on my books, a little lower?
Right. Yeah, we've definitely run into that in the past. Right? It's hey, this is the fair value amount, but my market price is what I could go out and get it. Go out and sell it for. But under GAAP, if you've chosen that fair value methodology, you really should be utilizing what that fair value estimate is from that third-party valuation. And again, it's a tricky year for sure, just because there hasn't been a lot of buying and selling of MSRs. I think those that are retaining are looking at it from an advantage standpoint of those loans probably aren't going anywhere, right? And they're going to be in that portfolio performing for a long period of time, just because the borrowers are pretty satisfied with the rates that they've got. So yeah, we want to get away from that as much as possible, and lowering the standard from a standpoint of where that asset is being valued at. We really want to rely heavily on that third-party valuation. Other common adjustments, again, that we typically see, whether it's first-time Richey May clients or recurring, segregation of escrow, cash, and payables, branch receivables and payables. So if you have any branch agreements, making sure that a reserve, if you do have a reserve booked against a branch, making sure that that's documented in the branch agreement. That's an important one. Servicing advances, this is a big one, obviously, this year. Vetting out how much of that is collectible. So really kind of looking at your advances at year end and trying to determine, do I need to be booking an allowance against any of these? Payroll tax accrual, another one I think that could stand out this year. A lot of times I feel like clients they'll book that payroll tax against the salaries and wages at year end, but they might not do it against the bonuses, commissions. Probably looking at that again, because I know this year's a unique year. Given the climate especially for commissions and definitely for bonuses, if there's any kind of bonuses that are going to be paid out after year end, just because companies have been so profitable this year, that you're making sure that payroll tax accrual is made. Other items, warehouse interest and fees accrual, am I properly booking that? Deferred rent, another ticket item, that'll go away as soon as ASC 842 comes into effect, but until then, it's sitting there on the balance sheet as a liability. PTO accrual, another important item I think for this year. I've had some conversations with clients that have looked to make changes to their PTO policies this year, just given that underwriters and processors and all the back office support has been just working like crazy, that they haven't been able to take time off. So just keeping that, keeping that front of mind if you are making any changes to your PTO policy, how that might affect that accrual. And then any adjustments to opening equity. I feel like, best practice there is to any journal entries that we made last year, if equity's not rolling, it's probably due to the fact that a journal entry might not have been properly booked on the client's books. So if equity's not rolling, that's probably the case. And then just a best practice. So just reviewing that prior year letter to management, taking a look at what your adjusted journal entries are, taking a look at what the proposed journal entries are, and seeing, what have I done internally to make sure that these entries aren't going to be repetitive. The reclass entries that we've been booking in the past, those seem to be pretty repetitive, just because, clients don't necessarily want to add additional general ledger accounts, and those are just entries we want to make sure that the financial statements are presented, across the board in standard format.
So Josh, in the interest of time, we got 20 minutes left here,
right.
And definitely we can cover any questions again that come in through the chat. Let's pivot to process of the audit, kind of the procedural aspect of it, and maybe some of the logistics of the audit. What, especially again in reference to the craziness that is 2020, what will look kind of new and different this year, and what can I expect to stay the same or be familiar?
Yeah, absolutely. So, we can definitely speed it up. That was kind of the plan here. It definitely would be my preference that HUD doesn't decide to move back the deadline this year, and they stick to March 31st, because I want to enjoy my April. But yeah, I think, from an audit standpoint, just to give you, our clients an update, our current protocols here is only essential business travel is permitted. We've already communicated to a lot of our audit clients that we plan to do the audit remote unless they feel, strongly otherwise. How are we preparing for that, I think, is always the question, that we've been getting from our clients. We've made a push the last couple of years to go remote as much as possible, especially for those clients that we've been engaged to for a number of years. Things, tend to go smoothly, saves on travel costs and time. So, things that we're, letting our team know internally to make sure it's a success for our clients and they feel well taken care of. Obviously, wanting to take into account any time zone differences, especially for our East Coast clients that are 2 hours ahead. I think right now, what we can be doing to set ourselves up for a successful audit is establishing that best form of communication. So we've been, we ramped out and started utilizing Microsoft Teams and SharePoint quite a bit about 2 years ago. So we're well versed in the Microsoft Teams world. We utilize it a lot this summer for clients. We do it a lot internally. So that's definitely what we tend to use a lot. If you'd rather use Zoom, if you have business Zoom, go to meeting, whatever it might be, we want to make sure we can accommodate to your needs and your preferences. We obviously have our conference call numbers as well, so we can rely on that. So really, we want to establish what works well for our clients and execute on that. I think when we talk about, client systems and providing auditors access, I think that was, Kaylin, I think you mentioned that, and we definitely want to talk about that. In the past, we have had our clients provide us auditors access, or almost like a read-only access to some of their loan origination software. This can be pretty vital for that loan origination testing on the compliance piece. When we look at the accounting software thing, so if you're on LoanVision, if you're on QuickBooks or LoanVision or AMD, I am aware that they have auditor packages or auditor, kind of reports that they can pull down, but definitely reach out, to your teams on the loan accounting software side to see if there's things that they already have in place, or if there's things that they can put in place, just to make your lives easier as we kind of go into year end. I think when we talk about planning ahead, interim testing, compliance follow-up, just more or less, these are kind of questions, that I try to make sure are accomplished with my clients. But if you're a client, these are definitely questions you should be asking yourself. You know, looking at whether there were any review comments either from the manager or partner that should be brought to the client's attention. So as we look at that, especially that compliance piece, if there's anything that could trigger a potential management letter comment on the letter to management, let's discuss that now rather than at year end. I know we've had, there's been some breakdowns definitely internally on the communication side. We can definitely, you know, kind of take fault on that, on not getting out in front of that more proactively. So if you haven't heard about it, definitely follow up with us and let you know, ask that question. Hey, how did the compliance results look? You know, are there any written MLPs? Are there any verbal MLPs? But we're doing the best that we can to make sure that we're getting that information out to you, you know, as soon as that manager or partner review the job. And then discussing any updated financial statement disclosures. There's not going to be a whole lot new this year. You know, on the PPP side, there would be a separate footnote for that. But I think a good practice, especially if you like to run over, you know, the financial statements with a fine-tooth comb, to ask what those edits look like going into year end. So if there's any language changes that you want to make as a client, that we can do that early rather than later. Game plan for audit field work, another planning ahead item. You know, looking at the vault room, do we have the correct individuals that have access to the vault? Is there anybody that's not a part of the company anymore that we need to remove the access from? Those are questions that we should definitely be asking. Have the audit confirmations been prepared? So looking at debt, legal, any, you know, receivables, making sure that those get prepared and are ready to send out in January. Have the third-party valuations been requested? So looking at MSR evaluations. If you have a self-insurance policy and you get it valued and have that IBNR accrual kind of estimated, is that being done promptly after year end? And then looking further down the road to the LEAP filing and kind of that last piece of the puzzle, just making sure you have the necessary steps, you have the person, you know, kind of authorized internally to kind of start that process. I know we've had a little bit of hold up, especially for those late March jobs. Sometimes, you know, we finalize the job and then you go to the LEAP system and there's a delay. So just making sure that we get out ahead of that as much as possible. Finally, on the planning ahead, you know, fieldwork time savers. I think the biggest thing there, you know, these can tend to suck up a lot of time during field work. You know, if you have time now, especially in December, are you updating the MSR roll forward? So a lot of clients I feel like have a general ledger account for those additions to the MSR portfolio, but they don't always have accounts for the deletions or fair value adjustments, or sometimes they're commingled. We like to break it out, obviously, on the roll forward. I know it's broken out on the MBFRF reports. So again, probably rolling that forward, making sure it's dialed in through Q3 is a good practice. Future lease commitment schedule, you know, definitely updating that as much as you can if you've had time to. And then if you're a C Corp, you know, it's been a very profitable year. So if you haven't already, you know, possibly taking a look at that tax provision and getting that updated and rolled through Q3, you know, potentially booking some adjustments through Q3 so that it's not such a significant adjustment year end. And I think best practice here for planning ahead is really to hold us accountable. You know, let us know what's working for you. Let us know what's not working for you. You know, I know the vault tends to be one of the areas of concern, or whether it's communication, but if something's not working, please let us know so we can fix it. So I think, again, we talked about, you know, battling redundancies as part of those questions. I think that's more, you know, kind of what I communicate to my clients. It's just, you know, it might be a new in charge on the job. It might be a new senior on the job. They might be asking repetitive questions. I think just bear with us, especially kind of given, you know, the remote nature of the audits. But again, kind of going back to what I just said, letting us know if something's not working so we can get out ahead of it, I think is key. Requesting prior information. Again, if there's something that you need from us, if it's the payroll reconciliation, if it's a lease commitment schedule, I mean, we're very template driven on our side. So if there's something you want to take a look at prior to year end, you know, hey, Josh, send me the fixed asset schedule through last year. I just need to make some updates to it, or make sure you have what I have. Or if it's amortization schedules that are related to your MSRs or your debt agreements or whatever it might be, ask for those items ahead of time. You know, a lot of times we'll build some stuff out, whether it's the lease commitment schedule, the payroll recon. So the more you let us know what you need ahead of time, it can definitely kind of save time on the back end. and then updating the auditor. So obviously, you know, some of you have gone through that interim process already. You kind of check the boxes on the planning piece. If there's any changes that have happened, you know, from when you last spoke to the auditor through year end, so if it's operating agreements, if it's amended or new warehouse lines of agreement, give us a heads up, you know, so we don't have any, I guess, January or February surprises, for lack of a better term. And just so I guess, you know, more than anything, let us know so we can do what we need to do to make sure we're properly testing those areas.
Josh, if I am a brand new, you know, accounting staff, manager, controller, CFO to my company, and haven't been through the audit process before, can I kind of lean on my audit team to help me through, you know, help me understand, offer me another avenue, I guess, aside from those that aren't familiar, because we're, you know, in all likelihood, right, all of our clients are spread thin, right, in the accounting departments, especially with how busy things have been.
Yeah,
so
no,
the
absolutely.
audit provide another resource.
Yeah, absolutely. I mean, that's ultimately what we're here for. You know, we're looking to make this as easy as a process as possible, and really be a partner, you know, with our clients through that audit process. Definitely just reach out to us, you know, to discuss how how the audit process has been in the past, you know, what your experience level is, what your comfort level is, I guess, with the mortgage process, and just making sure everyone's kind of on the same page in terms of communication. So we're definitely, you know, it's not, while we have a similar audit approach, it's not a one size fits all, right? So, you know, if you want daily check-ins, if you want weekly check, whatever it might be, you know, let us know what works well for you, and we're definitely willing to accommodate. So we're moving on to the last piece here, and then we'll have a few minutes for questions. So I think other impacts, so this is kind of that bookend, things that could change from year to year. You know, I won't read through all this. You guys can read through it at your convenience, but I think that there's been a lot more, more or less, a lot more decision that's been made about this. There's been a little bit of waffling going back and forth over the last few years in regards to the MBA, you know, kind of stating, hey, here's our stance with those Ginnie Mae delinquencies. And again, if you're not Ginnie Mae approved, probably go top off that coffee again. But where they essentially are landing on is looking at their interpretation of a more than trivial benefit of any delinquent and or loans in forbearance that are Ginnie Mae pooled. And where we've landed on, I know, is looking at making sure not only that your delinquent loans are being held on the balance sheet as an asset as well as a corresponding liability, but also those loans that are in forbearance are included in that number. I've had communication with a few of my clients about this already. You know, they're accounting for both, but just as a best practice, you know, again, probably reaching out to your warehouse banks, reaching out to those contacts, and kind of looking, you know, where you stand right now with those forbearances, with those delinquencies, 90 days plus, and how that might affect any warehouse covenants, and just getting out ahead of it now is probably more than anything our advice. We've talked to a few banks about that, just kind of made them aware of it, but definitely a good point of interest for those.
Josh, can you break down really quickly, sorry, I was cognizant of the time here, what is the foundational principle of what you're talking about here? Maybe for me, if I'm a lender that's seeking Ginnie approval, you know,
right.
I got slammed by the correspondence in terms of the Govy loans I did earlier this year. So now I'm seeking Ginnie approval so that I can have that outlet to issue some securities. What kind of accounting concerns should I be thinking about as I'm seeking Ginnie approval? What's the foundation?
Yeah, so again, it's, you know, when we look at Ginnie loans and Ginnie pooled loans, I think, you know, we get into the kind of the nitty gritty of what we're looking at. And it's essentially, we look at these as FASB ASC 860, so it's sales accounting treatment, and it's looking at, you know, it's not attained when a seller has the legal right to buy back an asset. You know, so again, when the mortgage company has a unilateral right to repurchase that loan that it has previously sold, they consider it that repurchase, you know, kind of opportunity provides more than a trivial benefit. So what our suggestion has been in the past and continues to be is that they record that call option, you know, for its right to the loan on its balance sheet, and then have the corresponding liability. So it grosses, it nets to zero, and really it's for that principal amount of that loan, whether it's in that 90-day plus delinquency status or in forbearance. Awesome. And again, just further to that point, it's been a number of years, but the MBA has, been in discussion, and FASB has adopted that broad perspective, looking at it as their interpretation of the more trivial benefit. A couple other items, and then we can skip ahead. We have a few more minutes left. So just looking at other items of note as we kind of roll into 2021. Obviously big topics of conversation. We won't go into too much detail, but just that adverse market refi fee, the 50 basis points. A lot of clients have already are starting to count for that, but it looks like that'll be effective 12/1/2020. No change there. A couple of items that have been kind of hot topics of discussion is what happens to the conservatorship of Fannie and Freddie going forward. I know there's been a big push to get them out of conservatorship by Mnuchin and Carson, and what that looks like going forward. That'll be obviously a hot topic. Obviously CFPB, that can be a changing, kind of a changing climate, I guess, based on any changes to the administration. And then obviously, potential tax credits for first-time home buyers. So again, if anything, I think that could spark a surge in purchase demand. But I think, in light of what's been happening recently, it seems like rates are going to be holding pretty true, that we do expect a good Q1 for a lot of our clients. But I think that these kind of 4 items seem to be on the forefront of a lot of people's minds.
Yeah, I'll just plug here that we're watching all of these things closely, and how, trying to think ahead about how they could impact your everyday lives, beyond just the markets and what it does for your client, your customer base as borrowers, more acutely what it does to what we can do to look ahead and provide some insight on how it might impact your world in the accounting department, the finance departments of these lending entities. So thank you, Josh. I think certainly got through a lot there. I guess I'll check in with Eliza. Is there any questions that came through? We have about 2 minutes now to address.
We kind of have one that you guys already touched on, which was thoughts on the CFPB with changes in 2021. Obviously, that's kind of a situation that is affected by whatever happens politically. But I feel like you guys kind of touched on that. We also had another one, which I think is somewhat related, anticipating increased taxes should distributions be considered.
Sorry, one more time on that one, Eliza. Sorry.
Yeah, it's not really a complete sentence, but it says anticipating increased taxes should distributions be considered.
Yeah, certainly, and that's always a balance, right? Of it depends on your entity type, obviously. Distributions out of a C corporation are taxable, whereas for the most part, with some safe assumptions, distributions out of a pass-through entity are not taxable. But yeah, I guess to dive into waters we were trying to avoid a little bit, in all likelihood, as we stand here today, it looks like potentially, lightning would have to strike twice for the Senate to, end up with Democratic majority, or Democrat majority, I'm sorry. And so I really don't see much tax policy getting changed unless that lightning does strike twice, and the Democrat party owns all the Congress and the presidency, the executive branch. So as that starts to become more clear here at year end, yeah, certainly something you could consider taking out distributions at the likelihood that tax policy could undergo some significant changes. With that said, too, the only other point I'd make is that remember back to when the last big, huge tax bill was passed, it happened you know, well, I think it was in December of 17, if I'm not mistaken, or maybe even 16, but they didn't retroactively apply any of the provisions except for the things that were extenders of previous tax breaks. So that my point there is, if something wild and crazy and unexpected happens in 2021 where tax policy changes, it's very unlikely that they retroactively apply it starting the beginning of 21. It'll likely pass with an intended kind of imposition date of the following tax year.
Awesome, thanks. That was all the questions we had, and we're at our time. The contact information for Josh and Kaylin is up on the slide there, and obviously we will be sending this out from our info@Richey May email address. You can always respond to that. We have a couple people monitoring it to make sure your query gets to the right person. We will be sending out the recording to all participants, whether you joined us live or joined later. And again, like I said at the beginning, feel free to share it in case you were a little bit late joining. Thank you for participating and for all your questions. And we're looking forward to working with you guys again now on a great audit this year. Like I said, thank you and have a great day.